Hi, everybody, and welcome to the Middle Class Investor this week. This is Seth Martin. It is almost 12 o'clock on Saturday, January 16th, and the second full week of market action has also proven to be a down week. You can see here, I've got some key areas marked here on the chart. The August 24th low was 1867 on the S&P 500, and you can see we have broken that. And that's what we've been looking for. That's what we've been waiting for. So what does that mean? Whoops, sorry about that. So we've got, our high was back here in May, right around this area, and we made this August 24th low, and then we rallied up and made a lower high. So right here was potentially, and I stress potentially, a trend change, right? But you don't really know if the trend changes until you make this lower low. So, we've got, and even now, even right now, it's potentially. So, because this could be, notice it kind of looks like this little A, B, C type of correction also. But that's not likely the case because this is very large, and this ABC is very large. I mean, these are weekly bars, and it's not likely that the trend, or this pattern, although large, is not quite that large. So I'm leaning more to the bullishness of our markets, our U.S. markets, is in the rearview mirror, and we need to start looking to preserve capital, step to the sidelines, trim up some positions, maybe try to sell some bounces. If you get a bounce, you notice we got this channel that's kind of downtrending. We might get a bounce into that channel and then roll back over. So you might try to sell some positions as we bounce back into this channel, things like that. Let's look at the VIX. The VIX, obviously, we want to look at the VIX just to make sure that it expanded this week, and I'm sure it did. I don't know why I can never find the VIX. I know it's in this list, but somebody just type it in, VIX. And you can see that, as expected, the VIX expanded this week, and it pulled back to kind of a mid-range. It could actually just chop sideways for a week or two, and then lift, or even, obviously it could pull back. I don't think it's going to pull back much, but it could pull back a little bit and then begin to lift again. So the big question is, if you're in a 401k or you're trying to decide what to do, how do you do that? And I just want to reiterate that a while back, once we broke this trend line, I was talking about, especially after we had this August 24th, the week of August 24th down, and the week before, I was talking about, and we had this rally back up in here, I was talking about how, that the trend has been broken, and that potentially it's still bullish, and you could make another 2 or maybe even 3%, but the risk to the downside was substantial. And this is what I mean, because now we're not going to get another trip back up here to 2100. That's just not going to happen. Now you could get a move up into this area here. I think there's some gaps in this area here. Between this week and this week. So what is that? That's the week of that's the week after Christmas, and that's the first week of the year. I think there was a gap there, and it's possible we could get a bounce back in to close that gap and then drop off. But I don't know. I mean, these are pretty big weeks. I mean, barring something like, the market participants still believe heavily in the Fed, and at some point the Fed is not going to work. In other words, if they announce QE4 or whatever number we're on, you could get a bounce up into this area, but then I think it's sold immediately. So, in other words, something like news around the Fed could actually make the trend, wobble a little bit from week to week. But once the trend is in place, that trend tends to stay in place until all the degrees of trend are worked out and things like that. So, anyway, just a heads up that we did make a lower low. Now, interestingly enough, if you look at the Dow did not, and this could also be bearish potentially. Let me explain, because a lot of times when market starts to sell off, the participants in the market, they have to sell their riskier positions. It could be semiconductors, it could be healthcare, it could be biotechs, and then what happens is that money tends to flow into Honeywell, IBM, GE, big Dow stocks. If we look at IBM, I'm just curious to see if IBM was down this week, but not, just looking at it, not as much as the overall market. If you look at Honeywell too was down this week, but not as much as the overall market. If you look at Apple, now I don't know, Apple's had a pretty good run. People have been selling Apple, but you can see that it was down, but not as much. Trying to think of some other big Dow stocks. I don't look at Dow stocks that often, so I'm not looking at them. But you've got Coca-Cola, KO. So you can see how it was down, but hardly at all. Walmart. Now Walmart's been on a tear lately, so Walmart was down this week, but that's after rising for the last several weeks. So anyway, the whole idea about the Dow being down or not being down as much could actually be a bearish sign. But usually these indexes move together. So if the Dow looks like this, usually the S&P looks like this, and the Nasdaq tends to look like this, but just more extreme. You can see that was on pretty heavy volume. That down day, it was on heavier volume than, that down week, heavier volume than last week. So, I don't know. I think it's just prudent to prepare for market sell-off. I was looking to see, how far this sell-off might go before we get any kind of substantial bounce. Just this first move, which may be actually the second move, right? Because this was your first move, and then this is your retrace, and this is your second move. But if you just estimate this move down here, still a little Fibonacci retracement up to the May high, and then zoom out. I mean, you could see the S&P pull down here to this 1450 area in pretty short order. 16, I would say anywhere in between here. You could see that area pretty quickly. So we just want to keep that in mind. I mean, you need to think about things like that when you're talking to yourself and you're saying, well, should I step to the sideline? Should I wait? It could be that we get this bounce to close this gap first, and then we get a big sell-off down into that space between 1600 and 1450. There's no way to know. So you just have to pick a spot and say that's all I'm willing to give the market. All right, let's look at the 10-year Treasury. That market I'll admit has been baffling me a little bit. It does make sense that money would flow into the 10-year Treasury if the market is selling off, causing rates to go down. But they really can't go much lower. Well, I've kind of got this line in the sand right here. They really can't go much lower than this area right here, this 1.8. If they go much lower than 1.8, then potentially we don't have the right analysis here, the right technical analysis on the chart. In other words, this might not be our first move up, and this might not be the first pullback. But having said that, the high yield market is under a tremendous amount of stress, and eventually that's going to spill over into the U.S. Treasury as well and cause higher interest rates. So still, I mean, if you go into bonds, that's fine if you're going to put some money in bonds, but just keep the duration short, 2 years or less. That would be what I would do if I had to be in bonds. We're going to look at Germany and the UK in a minute. Japan, all these global markets are really suffering from a tremendous amount of debt and a lot of money printing. And money printing doesn't help with debt except to devalue the currency and inflate the debt away. That's really the only way it helps it. It doesn't pay the debt off. It doesn't relieve those individuals that have that debt of the debt itself. It just printing money just makes the money that you pay the debt back with, less valuable. So the problem is governments have always, they've always done that. They don't ever just say, hey, bondholders, you're not going to get paid. That almost never happens. What they do is they fire up the printing presses and they start trying to print their way out of it. And who knows if that's what the U.S. is going to do. There's no way to know. The way I've explained the whole protect yourself from the government money deal is it's like a chess match. So, something happens, the government makes a move. Well, then you make a move. And then later on, it gets worse, and the government makes another move. Well, then you make another move. And so it's not something where you can say, go buy gold and you'll be fine, because that may or may not be the case. I'm not saying you shouldn't have some gold or some silver, but to go out and just liquidate your 401k and put it all in gold at this point in the game might be a little extreme, given that there's no rumblings, there's no now if they get on TV and they say we might have to do QE for the foreseeable future or something like that, then you're probably going to see gold and silver spike up, and maybe at that point then you should start maybe trying to figure out what you're going to do with your 401k, because the problem with your 401k is it's locked up until you retire. Well, if you retire, whatever a dollar buys today, let's say only, maybe you have to have $10 to buy in the future. And let's say your 401k grows to $1 million. Well, that would be like having $100,000. So, can you retire on $100,000? Probably not. I mean, would it be worthwhile to take the penalty, pay the taxes, and convert that money into something that, that can't be printed? Potentially. But you have to kind of step your way through that. You can't just know that that's going to happen and start preparing for it in a big way. Now I have a little bit of silver, a little bit of gold, but nothing like the amount that would be in the 401k. So anyway, like I said, all these governments, our government, the UK, Japan, China, Germany to a less extent because they're in the euro. The euro countries aren't really behaving this way. entirely because they're connected, so they can't really do that. The ECB controls the supply of euros, and the ECB can print money, but it generally speaking, who that benefits, or who it disbenefits, it disbenefits the whole European Union, devalues the euro. And they're doing some of that. It's just they're not individual countries doing it. It's the Euro group. Let's switch over. Let's look at gold. Gold has been. Sorry about that. Gold topped here in what was that? 2011, and it's pretty much been going down the whole time. And you can see we started looking at places for gold to turn right here, and then again right here, and potentially we're at that place. We're showing a little. I thought it was right here. We hit here, bounced, and then totally sold back through it right here. But it looks like we're doing kind of the same thing. The question is it going to come back and sell through it, or is this this series of lows going to hold and we're going to bounce and break this down diagonal trend line? It's downward sloping. If we do, then we're probably looking for gold to come up into this area here around 1350 or so. Still not a bad place to buy gold here as it bounces around this bottom, because once it takes off, it's going to take off pretty quick. And then, to buy physical gold, you have to buy it through a dealer, and there's commissions involved, and it's not as easy as just going into your brokerage account and buying 100 shares of stock. It takes a day or two or three even to get that all lined up. So anyway, that's gold. The dollar, we've been talking about the dollar for a while, and I've shared with you the problems that I saw mentioned, where I thought gold was bottoming, but then the dollar looked like it still had room to run. So these things don't necessarily go together. And it's probably why gold has not substantially taken off from the levels that it's at. So the dollar now is clearly, it's just weeks away from making a new high. Probably will come up into this 104, 105 area, and then we should have a substantial pullback in the dollar, because this will be the end of, let's see, this is we should have a pullback in the dollar that should take us to below these lows here over the upcoming decades or whatever. So we're probably looking for the dollar to come down here below 70 once we finish getting up to wherever these highs are going to be. Let's look at NinjaTrader and look at oil and those commodities. That's a monthly chart. Let me put it on a weekly. It's going to take just a second to pull this up. Oil is gone lower, I think, than anybody thought. It's right at the area I talked about last week or the week before, where I thought it would. Where I thought it would go to before we get a bounce up into this area, and we're getting close. We're getting close to that happening. So you might see oil. I don't know. You could see oil. Whoops. Let me nuke that. Let me zoom in a little bit here. You might see oil make another. This will run here. Looks to me about done, but you might see oil make another little run up and then another little run down, maybe to there. And then we'll start seeing oil work its way up, up into this area here. So if you're looking to trade oil, wait till it stops going down. I know that sounds almost cliche, but wait till it stops going down. Wait till you get a close. Like if I were looking at where to get in with oil, and we've talked about this type of technique before. Let's say next week we get another down week. Let's say it looks like this, and oil actually almost goes to 25. So let's say you get a candle that looks like that. And then the following week, you get a candle that looks like that and closes. Well, then you might look to get in the next week, that very next week. Because now what we got is oil had just gone down. It's made it opened here. It ran the bears pushed it all the way down here. It ran all the way back up. And then we've got a close above the high of this week. And this is a pretty good entry technique. And then usually, the market, kind of meanders around and, goes higher from there, like so. And then we would look for oil to make it up into this area. But this is how you would get in. You wouldn't necessarily get in right there, because you don't know if it's still going down. You want to look for kind of a bottoming pattern, and these three candles together make kind of a bottoming pattern. That now doesn't mean that it has to go up there. No, of course not. It could go up here, and instead of this bouncing right here, this could just roll on down and make a lower low. So what you want to do is make sure you have a stop below this low, and to protect your downside risk. So that's oil. What else do I have in here? Let's look at the FTSE. The FTSE, I was looking at this earlier. The FTSE looked like it made a lower low, lower than this low. So now you've got a trend change in the FTSE that seems to be aligning with the S&P 500. If you go to the DAX is kind of like the Dow. It's up higher than that previous low. Those of you that are more familiar with the DAX might have more insight on this, but I'm just looking at the chart and see what I see. If you look at the ES, which is the S&P future, well, I'm not sure what's going on here. We've got some sort of ringing. Oh, okay, I see what happened. I had some dialog box open, excuse me. So if you look at the ES, I would say the odds are that we get the ES next week continues to sell. And now it could come up. I mean, you can see here, the market came all the way up and then sold off, and then it came up and then sold off, and it came up and then gapped down. So you could get, you could get a range bar that looks like this, but then closes lower. Excuse me. And then get another one that looks like this. And then eventually I think we're going to get down into this DP area. Maybe like this. Something like so. And then we're going to want to look for a pretty good bounce. And this is the bounce I was talking about. It could bounce pretty substantially up here. Could close these gaps up here. You got a gap right here. You got, seems like there was another gap in here. Maybe there's not a gap on the futures. And maybe that's what's going to drive, this retrace. But you could get, once we get into this 1800 area, you could get a really significant retrace. You could get something that, runs us all the way back up like this to 2040. And then, trust me when I tell you, you need to be gone. Okay. A good way to kind of estimate where you need to be gone is let's assume this down is all one move. Excuse me, I got a little dry spot in my throat today. And what you can do is you can use a Fibonacci tool, Fibonacci retracement, and you can click on the high and come down to whatever the low is. Wherever it stops going down, let's just say it stopped going down there today. Well, then you could look for a retracement around 62%. And maybe it's through going down. I don't know. Doesn't look like it. And even in the futures, we haven't taken out the August low. So not sure what all that really means. But in general, you want to look for, once it stops going down, you want to be gone in the rally once it reaches about 60% of its retrace. That's the day you want to target. To get back on the sidelines. And that process may have already started. I don't think so, but it could have. Seems like to me you would have, you would have some price action come down into this decision point, which is off of this pivot here. But that's not the case. And the interesting thing is, I really don't see any big volume spikes here when the market came down and kind of crossed this previous low, this previous pivot. So that tells me that we probably got a couple more down weeks, and then we're going to see a pretty good rally from there. And that you should use that rally to start picking some places to get out of the market. That's really about it this week. I don't want to, beat a dead horse. The global Dow, let's look at the global Dow. We haven't looked at that in a long time. The global Dow, you can see, is substantially down, gapped, and just kind of ran away. If you look at, what's the other global? Wilshire. Like if you look at the Wilshire 5000, a lot of people like to use the Wilshire because it's 5,000 stocks, and it does make good waves without unnecessary gaps. But you can see that the Wilshire made a lower low than the August 24th low. And this is usually not good for bullish people who are bullish on the market. You could get just kind of a minor retrace and then just all hell break loose on the downside here. So be very careful, be very vigilant. If you don't feel 100% comfortable or 90% comfortable with what you're about to do, just stay on the sidelines and watch. You'll sleep better and you'll hold on to more of your money. Trust me. All right, everybody, that is it for the week. Thank you for tuning in. If you have any comments, feel free to go to the comment section and comment on anything I've said here. If you want to take issue with it, or you want to elaborate on something, or just anything along those lines, feel free to comment. Just the only thing I ask is that we, keep it civil here. We don't call anybody names or anything like that. So I hope everybody is going to have a great 2016. If you're directly employed in the oil business, you're probably not going to have a great 2016, but use whatever spare time you have to develop yourself and your skills, and get out there and find something where you can provide some value for somebody, and you might have to change careers. That's kind of this economy. So, all right, everybody, thanks for coming in, and don't forget you can follow me on Twitter at the @InvestorClass, or you can just go search on Middle Class Investor and you'll find my Twitter. Although I don't do much with it. The videos get posted there, and if I do see some interesting articles from either David Stockman or from Zero Hedge, a lot of times I'll tweet those out. And lately I just haven't been spending as much time there, but I probably will now that the market is selling off in a big way, and there's probably some interesting dialogue there that could use some tweeting. So, All right, everybody, have a great weekend, what's left of it, and we'll see you next week on Middle Class Investor. Thanks for coming in, y'all. Bye.